Hey, welcome to our Market of the Moment update for the week of November 15th. Got Chris Madrid on with us again today.
Hey,
Welcome, Chris.
what's up?
Hey. Good to be back. We've taken a couple weeks off due to Chris had a family emergency and didn't get back till the start of the week. And then we were both swamped. So we weren't able to do 2 weeks, but we're going to get caught up this week.
For sure. We're back at it.
A Zarka sponsored show. All right. So we're going to start off as usual. Chris is going to go over our current rates, trends, and we're going to talk a little bit about inflation. So take it away with what's the rates going.
Yeah. So we, in the last, let me get my dates correct. Yeah. So since last, like Thursday, Friday, we've seen rates do this, just creep up a little bit. What's interesting is we went from, I would say high twos, right, which was 2.8 range, up to now 3.1, right, which isn't an eighth a quarter, right? It's not a huge difference, but it's just the idea of, I almost feel like they're teetering with the idea of like, okay, how are people going to react once rates start to and and I imagine over the next probably 6 to 12 months we're going to see a little bit more of that, right? We're going to inch up a little bit, we're going to come down a little bit, we're going to inch up some, and we're going to come down some, to where like there's more and more that I'm seeing right now that we're going to be in the fours next year.
Yeah.
Right. And again, we keep talking about the impacts that'll have on monthly payment, on affordability, for nothing less, just as education, right? You need to know how it'll impact your ability to qualify, and then ultimately your monthly payment. So yeah, so right now we're still in that 2.8 to 3 range. You can still get down to the 2.8 range, slightly lower, but it's now going to cost points, right? Which people talk about what does that mean? How does that work? In a nutshell, a point is typically 1% of your loan amount. So the amount that you're financing, 1 point is 1% of that loan amount. So if you're financing a $300,000 loan, you're paying an additional $3,000 in closing costs, and that's essentially used to buy down your rate. If the going rate was 3.125, at an APR of 3.297 or whatever, you could potentially buy down with a point to 2.875 APR of 2.970. So those are the differences that we're at now versus where we were before. You were starting at that 2.875 range, and then you could buy down to 2.625, right? So now we're seeing those buckets move upward, with the general consensus that we're going to be significantly higher next year, which again still is historically low, right? I want to, yes, even though it sounds like bad news, mortgage rates are going up, we're still less than half of what the 50-year average of mortgage rates are. So I think at the end of the day, that's the conversation. Whether you're borrowing at 2%, 3%, 4%, 5%, 6%, anything under 8% is 8% is the 50-year average. So if you're under that, which right now we're less than half of that, it's free money, right? Essentially, you're borrowing at nothing, and then not to mention, like, mortgage interest is still one of the few things that's tax deductible, so you get to deduct some of that on your taxes. So the upside is if you do have a higher interest rate, you have a bigger deduction. So
there's always a bright side.
We try to point the bright things out here.
So I can pay $3,000 at closing versus that interest rate over 30 years. So that's definitely a smart financial decision if I can do that or want to do that.
For sure. Yeah. And again, it's just having a conversation of, one, making sure you have the additional funds to be able to do that. And then two, that the idea of paying points, right? So if you're prepaying interest is what you're doing, right? So you're paying interest up front, but then have that lower rate over the life of the loan. You just want to make sure that you're going to be in the home for that long, or that period of time, right, to where it's beneficial and you've broken you've broken even. So like the difference, that 0.25%. So let's just say on a $300,000 loan, that 0.25% difference in interest rates of about $41 a month, right? So over a 30-year period, if you end up being in the home for 30 years, the $3,000 potentially that you would have paid up front is saving you almost $15,000 over the life of the loan. So 3 up front, you're saving 15 over the life of the loan, well worth it, right?
Yeah.
But if, for example, if you're hey, my job's going to relocate me, or there's a potential that we're going to move in 5 years, then you may want to reconsider, because the break even for that specific option that we're talking about here is about 6 years, right? So you would have to be in the home longer than 6 years for that to make sense. So if you're like, hey, I'm not going to live here for more than 10 years, then let's do it. It'll be a great investment for you. But if you're thinking, hey, we're blown out in 5 years, maybe less, then no, keep your $3,000 and buy a really nice TV or something with it.
All right. Well, let's talk a little bit about inflation. What's that could mean to rates, how the Fed possibly use rates to try to control inflation. So if you don't know, inflation basically is your dollar's not going to go as far. It's not going to buy as much. And our federal government does use interest rates to try to help control that to some point. So, yeah. Chris, talk a little bit about the and the correlation between the two, if you could.
Yeah, I mean, man, here's the interesting thing, and I've been like saying this for years, is that current inflation levels, right, suggest that interest rates should be much higher than they actually are. So that's one of those things where, like, I felt 5 years ago mortgage rates should have been at 6%, but we're still at 5 years later, we're still in the high twos, low threes, right? The difference there, or why I think that mortgage rates should be at 6%, is because essentially mortgage-backed securities. So when the actual mortgage is securitized, sold in the secondary market, an investor, right, or investors have to then purchase those securities, similar to like a stock or a bond, right? They purchase those securities and are then going to be getting a payment essentially from that investment, similar like you would with a stock, right? If you get a dividend or something like that, you're getting a guaranteed 3% or 5%, whatever it is, return. That's similar to how mortgage-backed securities work. Well, if you're an investor and you're investing millions or billions of dollars, you're not going to want a 2.5% return on your investment, right? So that's where we saw the federal government stepping in with their bond purchasing, which is essentially artificially kept interest rates low. So yeah, I mean, I'm imagining that at some point it's going to have to get corrected, right? We can't just keep printing money the way that we are. But for whatever reason, like, I mean, investors are they're essentially faced with the challenge of getting the return of their money while lower than the rate of inflation. So that's the interesting part too, is that their inflation is I heard it yesterday, but now I'm drawing a blank. It's 5 or 6%. What's inflation now? You know that number off the top?
No, I don't know it off the top of my
head.
And
I just heard it yesterday. It's not in my notes. But if inflation's at 6% and you're getting a return of these mortgage-backed securities at 3% or 2.5% like they were last year, like that's just, it's not from an investment standpoint, it's not a smart investment, right? But here's the reality, is that bonds and treasuries, right? So essentially mortgages and treasuries are a safe haven for investors. It's not as volatile, right? It's a consistent 2, 3, 4%, whatever it is, return. So if you're trying to diversify, you want some of your portfolio being in the risky, stock market, and then you want it in the safe haven of treasuries and bonds, essentially mortgages. So yeah, that's the interesting part that we're in right now, where a lot of investors are essentially taking a loss for the safe haven of what mortgages bring. So it's, man, the next I think we all need to put on our seatbelts. It's going to be interesting the next few years for sure.
I think so. All right, well, let's move on to our current real estate trends. brought to you by myself. So, Collin County, as we look at our chart today, basically we're going to see a little more blue, which is things swinging in a more positive direction, I'd say. Some of these numbers, of course, if you're a buyer or seller, you might look at these differently. But in Collin County, our list price to ask price is at 101.3%, or about 1.3% over the list. And that's actually dropped 0.8 of a point from our last time we visited. So if you're a buyer, that's telling you that houses are getting a little more affordable in Collin County, not having to go quite as much over. I will, to be honest though, I put several people are under contract, listing and buying in Collin County the last week, and we were around 5% over on both as a buyer and as a listing as far as what we got. 7 days on market remained relatively the same. Kind of hard to drop much below 7 days on market. And then the month supply is dropped once again, another 10th to 0.8. Last time we looked, it was 0.9. Denton County also trending much the same as Collin County. Although in Denton County, you're still going to pay close to 2% over list, which is more than Collin County currently. 7 days on market, and Denton County lost another 1/10 of a month supply, and they're dropped below a month to 0.9. Dallas County, relatively the same, still can buy under list, dropped 0.4 of a point. Got 11 days on market, which went up. Last time we looked, it was 10 days, but our month supply dropped to 1.2. I know Chris remembers the last couple of weeks that we were doing this. Dallas actually was maintaining their monthly supply, but now it's dropped. Grayson County still can buy under list. It actually ticked down a little bit more. 14 days on market went up, and the month supply actually increased in Grayson County.
Yeah. Hey, while you're on that note, so I was a recent news article that I saw was TI, right? Texas Instruments is going to be opening a brand new plant in Sherman. So we've been saying, Oldham, you and I have been saying for 8 months to take yourself out to Sherman. If you're going to invest in real estate, or you're looking to still purchase, and you can correct me if I'm wrong, because you probably know these numbers more than I do, but you can still purchase a 3-bed, 3-bed, 2-bath home in Sherman for $275,000, right? Yeah. So that's like that is not the last, but that is one of the last places for affordable housing in North Texas, right? Obviously, you can still get that in Denison, but Denison's still going to be a little bit further north of Sherman. And of course, Sherman has everything that the shopping, the retail, the stuff that you need, and it's 25 minutes down 75 to McKinney, right? If you want to get to the Costco's and the all that other stuff, it's a 30-minute drive down into town.
They're going to have all of that up there soon,
but they need to hurry, because there's going to be a ton of people moving out there, and it's obviously going to cost, as the demand increases, so does the price. So
certainly, as people start moving out there, prices are going to increase just like they have here.
Oh yeah,
I believe Apple also has is it Finsar, or there's a company that works directly with Apple is also in Sherman. So Sherman's actually kind of becoming a little technology hub up there. So anyway, I did see your article that you had posted about that. I need to go back and read it. So yes, we've been talking about it now for many months.
Yes, for sure.
Because I think people think Sherman and Grayson County, and it's just not that far now that 75's been
widened. It's
a quick trip up there. So
yeah, it is.
a quick trip you cannot make is over to Tarrant County.
That's true. Oh gosh, that is the bane of my existence, trying to get out to.
But
Oh, goodness.
if you would like to get out to Tarrant County, because it is beautiful and a very nice county,
It is.
you can buy just over list out there. It's still remaining the same. Days on market's 8, about the same. And their month supply has actually dropped in Tarrant County. Some of those drops could be seasonable this time of year. People wait until the beginning of the year to put their house on the market. But we're going to talk
Yeah.
about seasonality here in a second as well. And in Parker County, the last county I always like to touch on, just west of Fort Worth, starts getting a little hill country out there.
Mhm.
You get 98.3%, so almost 2% under list in Parker
Yeah.
County, 13 days on market, and they have a 2.1 month supply, which has actually dropped a little bit. So I think it was 2.3 to 2.4 last time I looked. But so we mentioned a little seasonality there, how the days on market could be ticking down because people are holding off listing until the beginning of the year. Because normally October, November, December is generally seasonable in real estate. The market tends to slow down this time of year. I'm sure Chris can tell you that generally his buyer applications for mortgages drops a little bit in the fourth quarter, even though he's one of the top dogs in the industry. And often the top dog's business never drops. But true. The real
Hey, December's always has historically been one of my busiest months. So like let me think. August, July, August are typically like always the we close the most as far as that goes, but December is like second. Where again, for the biggest benefit there is you had to have closed and purchased the home prior to the end of the year in order to be able to file for your homestead that following year, right? So that's always a big push. And for those of you that don't know, the homestead exemption, if you're buying a primary residence, it's the discount off your property taxes. So you have to have lived in the home prior to the end of that year to then be able to request it and file for it the next. So I don't know if that has anything to do with it or if it's just people want to be in their home before the new year.
I think it has more to do with the fact we work hard throughout the year and we're working October, November, and December because we traditionally have good Decembers and Januaries as well. So, but just wanted to go over a couple stats. First, this first graphic is the chief economist from realtor.com. And basically, I could show you stats for an hour on the October housing data that came out, and demand is unseasonably high. October 2021 outpaced 2019 and 2020, which I'm going to show you here in a second. And then also the second infographic or graphic I can speak to from our current listing, but there's just such a low supply of houses on the market with such buyer traffic that if you are a seller, it's going to lead to multiple offers. It's going to lead to a higher sales price, and it's going to lead to better terms and basically an easier transaction for you. You would hope.
Absolutely.
Because buyers right now don't want to, rock the boat sometimes on transactions because they don't want to go through the process again of earning, and getting that contract and getting something under. So our last listing, was listed under 200,000, brought well over 2 and, just great terms for my seller. So if getting your house on the market is something you're thinking about, in January, February, these things Chris talked about with the trends, with interest rates ticking up, that's going to be fewer buyers in the market because it's going to drive down their ability to buy. And it's going to also possibly drive down your end-up sales price that you get due to what a buyer can buy. It all based on if they can't buy it, then you can't sell it. So you want to speak on any of this real quick, Chris? Or is that
no, you got it. Yeah, you covered it for sure.
And I'm sure you're making a lot of calls to listing agents, making sure that they know how strong your buyer is and things of that nature. So
Absolutely.
Show this quick video, big 47 seconds.
Yeah.
So, basically just wanted to back up with some stats, the things we're saying there. And as you could see, 2019, I think you were over 30 days on market during this season of the year. And today it's 17 days on market. So that's a very good indicator. So as always, there's a ton of real estate news out there. You can get it in lots of places, but we prefer you come get it from us, because we are always studying the market, talking about it. That's what we do. So, Chris, you got anything to add before we sign off today?
Happy Thanksgiving. I don't know if we'll be doing one next week, so y'all have a happy Thanksgiving.
We probably will be taking next week off. Thanksgiving, you going out of town?
We're not. Well, if you consider Weatherford out of town, I guess Weatherford
that's where we're going, to Weatherford as well.
Yeah,
maybe we can go together.
Yeah, hold hands and stuff.
So we'll get a hold of Amy and I if you're interested in buying, selling, or investing. Touch base with Chris, refi. That's who we'll be putting you in touch with if you're buying with us, because he gets us taken care of. So
yeah, one of the just the last deal. So one of the things that we're kind of talking about too is student loans, right? So student loans are starting to now come due, and we're seeing a lot of those, between 5 and 7%. So the conversations that we're having is because equity positions, people that own homes, equity's higher, right? So you can essentially cash out your equity, pay off your student loans at a 3-something rate, right? Versus that 5, 6, 7 rate of a student loan payment. So it's just it's still a really, really good time. We're having a lot of conversations about home improvements, debt consolidation, including student loans, or just, it's so crazy. Going through my database of customers, and customers I talked to, one yesterday was still at a 4% interest rate from a handful of years ago when they first purchased or whatever. So again, the biggest thing is just having an outlet, right? Knowing where to go for the information. So that's what we're here for.
All right, man. Appreciate it. Have a good one, and we'll talk to you in a couple of weeks.
Yes, sounds good. We'll see y'all next time.